Okay, what's going on, guys? Jay here. This is smarthelping.com. I've got a new model. It's for a coffee shop or cafe. Probably could be used for a restaurant as well. And so let's go through it. I've cleared out all the assumptions. The template will come blank. I'm going to walk through every single input right now, and I'm going to fill this out as if I were trying to build a forecast for a customer that was starting a coffee shop. All right, so start company name. We'll just call this Coffee LLC. Launch year, let's say 2023. Exit month, we're just going to run a 5-year model, so I'm going to select the last month in here. Note if you change the launch year, you also want to change the end month to match, for go out as far as you want, because this will update, the dates in here will update if this changes. Include terminal value, yes I will. And we'll do exit multiple of 6x. Note, this data table will populate once we finish updating. So sensitivity here, this model has sensitivity. We're just going to assume everything is base, but we do have drivers for what can be low and high. So if I put, let's say low takes the sales count and price of the base assumption and goes down 20%, and high will go up 20%. And you can adjust those. I've done the sensitivity based on those changes, and you can see what the IRR of the whole project ends up being. Debt funding under cash sources, we'll fill that out later. Taxes, we could just put income tax rate and this. And these aren't hugely important, but we do include. Okay, revenue assumptions. This is the main part. So we've got all these different types of coffee. We've got 26 slots for hot coffee types. We've got 23 slots for cold coffee types. We've got 6 slots for food. Now, what you're going to do is go through and determine the start month. So let's say it's 2023. Right now it's May. Let's say I'm not launching till July. So I'm going to start launching all these different types in July of 2023. So I can select, I like, if they're all going to be the same month, start month, I'll just select the first two, make sure they're both 7/1/7/1/2023, highlight and just drag down. And then we'll get the correct start dates there. We can do that again here. And copy and paste here. So we're starting everything in July 2023. Now I need to do pricing. So we have all these different types of coffees. I need to do pricing. Now, obviously, I'm not going to sit here for 5 hours and research the prices of all these. I'm just going to put in some numbers. This will be different on the market, the location, all these different specific things. But let's say on average, our low price is going to be $4, our mid is going to be $6, and our high is going to be $8. And I'm just going to say we're going to apply this to all these different types. And you don't have to use all these types. You could just use, you could have like 3 types or 5 or whatever. There is no limit on how much or how that you have to use all these slots. Okay, so we're just doing the same thing for all these. Now, I need to forecast how many sales I'm going to make for these different types per month. So on average, let's say maybe we'll sell 250 of each type per month, and maybe we'll grow that at, maybe 10%. I don't have any logic in here for growth. It's just hard coded. So whatever makes sense for your situation, you can fill in. We're just going to say this is our monthly sales. Maybe these are 100. Oh, maybe we'll do 100 for these. Okay, and then, so this is the total. For example, this one, espresso, we're selling 250 of these per month in year 1, 275 per month in year 2. We need to know how many of those are at the low price, the mid price, or the high price point. And so we'll say maybe 50% are at the low, and then 25 mid, 25 high. Again, that's going to be based on your own market research and data. We can fill those in individually for each type of coffee and food item. And then you'll start to see these numbers populate at the bottom and over to the right. Look at this over to the right first. So this is telling you in year one, I'm selling $8,000. Well, no, I'm making a gross profit of $8,250 for the espresso line, and drip 8,250, cappuccino 8,250. They're all the same because they're all the same. These are all the same. But this tells you gross profit. So gross profit is taking the cost of goods sold out of the revenue. We'll get into that in the next tab, cost of goods sold. And then you've also got you can see the annual unit sales of each type of coffee per year. So this kind of helps you check your assumptions and see if that makes sense or if it's reasonable. You've got that for all these types. You've also got the annual gross profit, annual sales in total per year. And that will change as these change. You've also got a sanity check here saying, okay, year one, I'm going to make 6,400 total sales. Sorry, this is per month. So this is saying on average, based on all these different assumptions, we're making 6,400 sales a month in year one, 14,000 in year two. And so you want to make sure that these make sense. And then if you look at the days per month you're open on average, and you can divide that by the monthly to get your average daily sales. And again, you can see if that makes sense based on your location and expected sales potential. And again, this is just the base assumptions. If you were to change the base to low or high, it would adjust all of those numbers up or down 20%. And the actual tab that sensitivity happens on is here. And this is the actual numbers used in the final model that goes through all the different financial reports. But if you just use base, then these numbers will be the same as what you have here. Okay, cost of goods sold. So here, let's say our cost is average cost per item. So let's say an espresso, we're charging for, let's say on average, if I think my average margin is 75%, I can just say my cost is going to be 25% of the revenue. So I can go here times 0.25 and say, okay, my cost on all these is 25% of the revenue. And you can see now the gross margin, you're making 75%. And this cost would be anything involved in buying the materials, the ingredients for each of these different coffees. You're going to try to break it down into a per unit amount and put that in here. And that will directly affect, that will affect your margins, your EBITDA, everything. That's very important. So you want to make sure you have a good understanding of how much you plan to charge for each of these types and how much it costs you to provide each of these different types of coffees or food. And you'll distill that number down in here. Now we're not talking about like labor. So labor we'll do on the next tab in management and all of that, but this is just direct ingredients and any materials that you have to pay for on a per unit basis. Okay, so we got that. So fixed and other, let's say you've got, at a location, maybe a couple managers. I'm just making this up. Maybe you've got utilities, insurance, licenses, what else? Other staff, maintenance, all kinds of stuff. And we'll say, remember, we're starting all these in July, so we'll start July with these. We'll say the expense is $3,500 a month. 3,000, maybe this is 550, 500, maybe 150, maybe 2,000, maybe 600. You can adjust these monthly costs in year 1 through 5. We're just going to put the same amounts in each one. We could also say no franchise fee. This would be relevant if, say, you were doing a Starbucks, but if it's not, you could put 0%. Other fees, maybe credit card fees, you could put maybe a couple percent of all revenue. Okay, so there's our operations. Now, there's plenty of items here. You could do more if you have more. Debt schedule. So we haven't defined this yet. We'll define this after we're done doing the rest of the assumptions. So we'll come back to this. Terminal value, you're not going to do anything here. If you want, This is for if you define an exit value based on some exit multiple, you can define how much of that was actually should be applied to any fixed costs versus as extraordinary income, and the only effect that will have is on taxes. Cap table. So here, let's say, this allows you to bring in outside investors. Let's say you're going to have 100 shares, 100% common. And then here we're going to say maybe you're going to raise money, outside investors, you're going to give 20%. The rest you're going to give to the owners. You get 80. And you just need to make sure the total percentage is defined for outside plus the total for inside investors or operators should always equal 100%. Let's just put a number in here right now, 50,000. I don't know what the actual equity required is yet. I have to finish filling this out. Let's say you're not going to buy the building. You could, and you could put that in there, and that will flow through to depreciation, and you can put in exit value as well. But let's say you are going to buy some equipment. So here, maybe you'll have coffee equipment, maybe a couple different items there, other CapEx. So you have a bunch of different items, let's say 5,000, 10,000. And then we'll say the useful life on these is 7 years. Let's say the month of expenditure is going to be July. Well, actually, so you're going to try to open in July. Maybe you buy these in like May. Okay. So you got some CapEx. You also might, furniture's a big one. Maybe you spend $10,000 on furniture, what have you. Okay. Now startup costs, let's say a website, maybe an app design. Maybe you'll have legal in here, maybe 3,000, 3,500. Okay, and now I believe we're all filled out, so we can go back to the global control now. Let's see, so equity required is still an NA. Let's see, what have we not filled out? These are all on. Got cost of goods sold. Let me go over here. Let's see, what is going on? What do we not fill out? So this is fine. This is, okay. I'm using VLOOKUP. So we don't want to leave these blank for our fixed costs. So we'll just keep these in there, and in the blank version, I'll just make sure those are filled in as unique items. So for fixed and other, I'll put a note here too. Make each item unique. So this should be like manager 1, manager 2, manager 3. This is all different. And then other items 1. So don't leave these blank. This does not need to be so big. Description, don't leave blank, and make unique. Make each row unique. Okay, and then you will not run into any problems as long as you do that. Now let's go back to the global control. Whoop. Okay, we got some numbers popping in now. So based on all the assumptions, if I go to my cap table, it says I need $88,000 to keep the cash above zero. And you can see we're going to hit that in June. We hit zero on the cash balance, but we never go below, and that's what the model will solve for. So cap table, let's say owners come up with 10,000. You raise 78,000, you give away 20%. Now, if you're not giving away any, you could just zero out outside investors, put all 100% to owners, and then you just make this equal this amount, or you could just copy this and paste values only into here. Okay, you can see the resulting cash flow, which is going to be the same here because the only one owner or operator. But you can spread this out. You could have multiple, what do we have here? Up to 20, and this row is always going to be overflow. So if I were to put 0 here, that all goes to overflow. Maybe you're raising some money. You'll give 20% away. You're actually not going to invest anything, but you're going to keep 80%. That's fine. You can do all kinds of different strategies here. I'm just going to put 10,000 into this. Okay, so now we know that. We could put some debt in here. Let's say you wanted to fund with borrow some money instead of give away equity. Let's say you want to do a $50,000 loan. You could do that, and then now if you go over to the cap table, let's go to the debt schedule actually. So if we do 50,000 in debt, we need to put the term. Let's say it's just a 20-year term with a 6% interest rate, 12 payments a year, and first payment date. Let's say this is going to be taken out right at the beginning of the year to get going, and there you go. So now if we go over to the global control, you can see the equity went down from 88,000 to 40,000. So if we go to the cap table, now look, it's only 39,945. So you now only need to raise 30,000 from investors if you put up 10. Usually borrowing money gives you a higher internal rate of return. Okay, so this looks fine. The sensitivity table is working. So this is saying what the internal rate of return is based on your sales count being low, base, or high, and the price of your items that you're charging being low, base, or high. And you can see that there. I feel like IRR is the most comprehensive output, so that's why I use that. You could do sensitivity tables for all kinds of these different assumptions. I think it might be interesting to show the different equity requirements with changing funding amounts, or maybe an adjustment. You'd have to bring in maybe various CapEx spend or startup cost totals. There's all kinds of different things you can do, but it does slow the model down, so that's why I've only put one, and I've chosen IRR. I was gonna do one with exit value. I mean, I guess I could. No, I can do it if you want to build these. You can research how to do it. It's not too hard to build a data table, or I can do it for you. There's probably like 3 or 4 I would add in here if I wasn't worried about the model going a bit too slow. It's still manageable, but it's kind of slow. So I just put the IRR table in here. You could probably do one for equity or for exit value based on different EBITDA multiples. You've also got and we haven't even been through the summaries yet, but on this overview tab, you've got a lot of the sales counts by category, hot, cold, and food for all the different types of coffee. And you've got charts for that as well. Let's try to format these so they all look congruent. You've got charts for those different data points. We've got evaluation. This is completely separate, but you can show based on the cash flows that the business produces, and then a potential exit at the end of the 5th year, and then using a revenue multiple or an EBITDA multiple. You'll get a enterprise value based on a discounted cash flow method, discounting all the future cash flows, discounting the exit value, and then getting a final discounted cash flow. This does not have net present value, doesn't have any investments. You can see that on the distributions tab. This is where you're going to see the project level, IRR, net present value of the future cash flows based on a defined discount rate. You can also see the investor's share and the owner's share. which is going to be driven based on the cap table numbers you input. This is a pretty important tab to look at. You can see where the initial investment comes from, what's the cash flow over time. If you don't want to include exit value, that's fine too. You can always just hit no on this, and that's fine. And then it won't show it. You can see here, it's just showing initial investment, 5 years of operation. I'll put this back in. Usually you want to include this if you want a proper discounted cash flow analysis. We do have income statement, balance sheet, cash flow statement, all operating correctly based on all the inputs. So income statement, sales, cost of goods sold, OPEX. You can do inventory adjustments. Here you can define if you're going to buy inventory ahead of time, let's say 6 months, then it'll buy all the inventory needed for the future. Every 6 months you'll buy inventory, or maybe it's every 2 months, or if there's no offset and you buy all the inventory and use it generally in 30 days, you could put 1. And that will affect cash flow. Like I said, we've got a balance sheet here that shows cash and inventory. Now, if we had inventory, let's say at 3 months at a time, you can see the inventory here lasts for 3 months, depletes, goes up, depletes, and again, that will affect cash flow. You can see inventory purchases here happening over time, and all this matches up with the cash flow statement, income statement, and balance sheet, monthly and annual. And assets equal liabilities plus owner's equity. All the checks are in there. So this is a pretty good financial statement pro forma output. You've also got the executive summary, which kind of shows everything. You've got your sales, cost of goods sold, selling, general, administrative expenses, EBITDA, other cash flow items, cash flow post-tax, and you've got IRR, equity required, total project cash return, equity multiple, and ROI for the project, and then for the investor view and owner view. We've got distributions, we went over that. Overview tab, we went over that. More visuals, just to get an idea of what's going on in the forecast. Valuation, we went over. Break even, just taking any of those variable costs and fixed costs and giving you your annual break even revenue. Monthly details, where all the logic is happening. So here's your sales count for hot, cold, and food per month by type and total monthly sales. Then here's revenue for your low category for all the different types. Here's revenue for your mid category for all the types. Revenue for your high priced category. And then you've got your cost of goods sold for each one as well. For low, mid, and high. And then you can aggregate all that into total cost of goods sold. You've got your gross profit. You got other fees as a percentage of revenue. You got your fixed costs here, EBITDA, other cash flow items, debt service, and final cash flow. So everything comes together really nicely. Everything balances. There's sanity checks to make sure your monthly and annual match based on that number. You've also got a lot of sanity checks at the beginning here to check if everything's balancing. You got your project IRR brought through to here. The only thing with the sensitivity tables, if you want to add more, is the inputs you're sensitizing. Like here, we're doing the low, base, and high. We're sensitizing these to see the IRR. Whatever you're sensitizing, those inputs have to be on the same tab as the data table. But you can do all kinds of sensitivity tables. It's pretty cool. You'll start to see those in my models going forward as well. All right, well, that's all I got for you. If you want to buy the template, it's a one-time fee of $45. You can get it in the link in the description box below. Also going to post it to some vendor sites. And don't forget to like the video, subscribe, and I'll see you guys on the next one.